Most people think commercial real estate is about owning buildings and collecting rent, but that's just the surface. Commercial real estate, or CRE, is actually and needs to be thought of as a business. And if you understand how it works, it can become one of the most powerful tools for building long-term wealth, freedom, and legacy. In this video, I'm going to cover how commercial real estate really works so you can make smarter decisions whether you're an investor, an existing owner, or just wanting to get into the business. What is commercial real estate? Let's start with a basic definition. Commercial real estate is any property used for business purposes. That includes retail centers, office buildings, warehouses, multifamily properties with 5 or more units, and even medical or specialty use buildings. Now, unlike residential real estate, commercial properties are value based on the income they generate, not just comparable sales or possibly emotional value. That's what makes CRE powerful. It's not just about what it looks like, it's about what it earns. There are really 3 ways commercial real estate builds wealth, and they all work together. Cash flow. This is the income you receive after covering all operating expenses. Think of it as your paycheck from the property. The structure of your leases, the stability of your tenants, and how well your property is managed, those all directly impact your cash flow. In well-managed commercial real estate, especially with long-term leases like triple net leases, cash flow becomes more predictable and scalable over time. Appreciation. In commercial real estate, appreciation isn't just about market trends. It's driven by performance. When you increase rents, fill vacancies, or reduce expenses, you improve the net operating income, or NOI. And when NOI goes up, so does the value of the property. That's called forced appreciation, and it's one of the most powerful aspects of owning commercial property. You're not waiting for the market. You're creating value through smart ownership, your decision-making, and action. Equity growth. If you use financing, every mortgage payment chips away at the principal, increasing your ownership stake. This is often overlooked, but over time, as debt decreases and value increases, your equity grows on both ends. It's like a built-in wealth engine. You're earning income today while quietly building long-term net worth. When you combine cash flow, appreciation, and equity growth, you get a cycle of wealth building that compounds over time. That's why commercial real estate remains such a powerful tool for investors who think long-term. Plus, commercial real estate allows for tax advantages like depreciation and 1031 exchanges that can preserve and grow your wealth faster than most investments. Let's talk about leases and how they work. If commercial real estate is a business, then the lease is the contract that runs it. It's not just about collecting rent. The lease defines the relationship between the landlord and tenant, and it directly impacts the income, risk, and even the value of your property. So let's talk about the types of leases. In commercial real estate, there are 3 primary lease structures you'll see. Number 1, triple net. The tenant pays base rent plus their share of property taxes, insurance, and maintenance. These are common in retail centers and are preferred by investors because they shift operating costs and risk to the tenant. Then you have gross leases. The tenant pays one flat rental amount and the landlord covers all operating expenses. These are more common in office buildings, although we are seeing a shift to triple net. Finally, modified gross leases. And this is a hybrid. For example, where the tenant might pay base rent and some expenses like utilities or janitorial, but not taxes or insurance. So why these lease structures matter? Your lease structure affects everything, not just cash flow, but valuation. With triple net leases, the income is cleaner and more predictable. It's also easier to underwrite for financing or for a sale because the net income is less volatile. If you got a gross lease, you have to watch your operating expenses carefully. Because if taxes or insurance go up, your net income can take a hit unless you renegotiate rent. And then there's terms and escalations. The length of your lease and whether it includes scheduled rent increases also matters. A long-term lease with built-in annual escalations like 2 to 3% per year helps preserve your purchasing power and increase the property's value over time. And if you have multiple tenants, staggering their lease expirations helps reduce risk and avoid major vacancies all at once. In commercial real estate, the lease is the asset. It's not just about the building. It's about the income stream that the lease secures. That's why we underwrite deals by reviewing the leases line by line. Rent amounts, terms, options to renew, responsibilities for expenses, it's all in the lease. If you want to grow wealth in commercial real estate, start by understanding your leases. Because how these leases are written and how they're managed is what ultimately drives your property's performance. So who's involved in commercial real estate? Commercial real estate is a team sport. One of the biggest misconceptions is that owning property is a solo act, but the truth is, successful CRE investing and management involves a lot of players, each with a specific role in making the property perform. It starts with the owner, whether that's a private client investor, a family office, a REIT, or a partnership group. The owner is responsible for the overall vision and decision-making, holding, selling, refinancing, repositioning, or improving the property. And then there's the tenants. Tenants are the lifeblood of your asset. In commercial real estate, especially retail or office, your income depends on the strength and reliability of your tenants. Good tenants bring stability, traffic, and long-term value. Bad tenants can create risk, vacancy, or drag down your net operating income. And then there's brokers, leasing and sales brokers. Leasing brokers help you fill vacancies and negotiate new tenant deals. Sales brokers help you price and position your asset overall for sale or acquisition. A good broker isn't just transactional. They'll bring you market knowledge, comps, strategy, and relationships that can make or break a deal. And then there's property managers. These are the operators on the ground. Property managers handle the day-to-day, collecting rent, coordinating repairs, handling CAM reconciliations, and keeping tenants happy. They protect your time and your investment. Lenders and debt partners. Most commercial real estate deals involve financing. Your lender is a partner in your deal, and your loan terms impact your cash flow, exit strategy, and flexibility. Knowing how to work with banks, private lenders, or debt brokers is a big part of commercial real estate ownership. And let's not forget about local governments and city staff. Zoning, permits, signage, incentives, code enforcement. These are all handled by the local municipality. Building a relationship with the city can make it easier to renovate, expand, or even lease your space to new types of users. So while you may own the property, you're never doing it alone. CRE success comes down to managing these relationships, assembling the right team, and knowing who to call and when. It's part real estate, part business management, part relationship game. Each player affects the deal. So relationships, strategy, and market knowledge matter. Now let's talk about how commercial properties are valued, because this is where commercial real estate separates itself from residential. In residential real estate, value is based mostly on comparable sales. What other homes in your neighborhood sold for recently? But in commercial real estate, it's different. Value is based primarily on how much income the property produces. Think about that for a second. The more money your property makes, the more valuable it becomes. It's not about emotional appeal, it's about math. The basic formula used to value income-producing properties is value equals net operating income divided by capitalization rate. Net operating income, or NOI, is the income the property generates after operating expenses, but before debt service. The cap rate is a market-based return rate that reflects the risk profile of the asset. Think of it like this. The NOI is what the property earns, and the cap rate is what the market is willing to pay for that income stream. For example, let's say your retail strip center generates $120,000 in net operating income or NOI. If similar properties in the market are trading at a 6% cap rate, the math kind of looks like this. $120,000 divided by 0.06 or 6% equals $2 million. That's your valuation, and that number moves if your income goes up or the market cap rate shifts. So if you want to increase the value of your property, you have a few options. Raise rents, either through renewals or new leases. Improve the occupancy. Fill vacancies with quality tenants. Lower operating expenses. Improve efficiency without hurting service. Enhance the tenant mix. Attract stronger brands or more traffic driving uses. Any increase in NOI leads to a direct increase in valuation, sometimes by hundreds or thousands of dollars with small changes. Now, cap rates vary based on location, asset type, tenant credit, lease length, and risk. A fully leased strip center in a growing suburb might trade at a 6% cap rate, while a vacant or outdated property might go at 8% or higher. The lower the cap rate, the higher the value, but also the lower the return, because it's considered safer. So remember, in commercial real estate, value isn't about what someone paid down the street. It's about what your property earns and what the market thinks that income is worth. That's why smart owners focus on income performance, because the better the property performs, the more valuable it becomes, with or without market appreciation. So let's be honest. A lot of commercial property owners, especially those who have held assets for a long time, are sitting on hidden risk or hidden opportunity. Not because they're bad landlords, but because they've never been shown how to treat their property like a true investment business. Here are some of the most common mistakes I see and what they might be costing you. Number one, not raising rents strategically. Whether it's due to long-standing tenants, handshake renewals, or a desire to avoid confrontation, many owners keep rents flat for years. But over time, inflation, market shifts, and increased expenses eat away at your NOI. You don't need to gouge tenants, but regular market-aligned rent bumps are essential for long-term value creation. Number two, skipping triple net reconciliations. If you own a triple net property and aren't reconciling taxes, insurance, and common area maintenance each year, you're likely covering tenant expenses out of your own pocket. This is one of the most common operational leaks in multi-tenant retail. Get professional help or a good property manager to close this gap. It's not optional. It's protecting your cash flow. Number three, letting space sit vacant too long. Vacancy is the silent killer. Every month that space sits empty is lost income, but also lost momentum. The longer it stays vacant, the harder it is to lease. Some owners overprice, hold out for the perfect tenant, or wait too long to refresh the space. Your leasing strategy should be proactive, not reactive. Number four, underutilizing equity. You bought this property years ago and it's gone up in value, and which is awesome. But are you using that equity? Many owners have millions in trapped equity earning really, really low returns. Strategic refinancing, upgrades, or even 1031 exchanges can unlock capital and reposition your portfolio for stronger returns. Number five, no strategic exit plan. Too many owners say, "I'll sell when the time is right," without ever defining what right means. The problem? Health issues, market shifts, or family changes can force your hand and you won't be prepared. A smart owner knows their numbers, knows their options, and has an exit strategy, even if it's years away. The truth is, most CRE property owners don't fail because of bad tenants. They fail slowly from passive ownership. So how is wealth really built in commercial real estate? By now you've seen how commercial real estate works: income, leases, value. But let's zoom out for a second, because owning a building is one thing. Building wealth, real long-term wealth, is something different. The commercial real estate wealth cycle. Here's how commercial real estate becomes a wealth building machine over time. Step 1. Start with income. You buy a property that generates consistent rental income, ideally from quality tenants under good leases. Step 2. Improve the asset. Over time, you increase rent, stabilize expenses, maybe make light improvements. As the NOI rises, so does your property's value. Step 3. Build equity. With each mortgage payment, you're paying down principal. Your equity is growing even if the market stays flat. Step 4. Refinance or exchange. After a few years, you've created meaningful value. Now you can either refinance and pull out equity tax-free to reinvest, or sell via a 1031 exchange into a larger or more strategic asset without paying capital gains. And finally, step 5, repeat. You rinse and repeat, scaling one property into two into 5, and eventually creating a portfolio that generates income, appreciates in value, and supports your long-term goals. This isn't just for big developers or full-time investors. Many of the most successful private clients I work with own 1 to 3 properties, but they've been intentional. They review their assets regularly, keep debt in check, and use tools like 1031 exchanges, cost segregation, and refinancing to compound wealth without starting from scratch each time. Commercial real estate wealth is built slowly, then suddenly. That's the big picture. Commercial real estate lets you build wealth without having to buy and sell stocks every week. It's a business you own, but one that works for you. And over 10 to 15, 20 years, it can fund retirement, support your family, or even let you exit the rat race entirely. It doesn't happen overnight, but it does happen. One deal, one lease, one smart move at a time. So by now you're probably asking yourself, is commercial real estate something I should actually get into? And that's the right question to ask. In my experience, commercial real estate works best for people who think long-term and value control over their financial future. It's ideal for entrepreneurs, people who understand risk and reward, small business owners, especially those who want to own the building they operate from, private investors who want to diversify out of the stock market and into tangible assets, and generational thinkers, people looking to build long-term wealth and create options for retirement, legacy, or future liquidity. And also for residential investors looking to scale with better cash flow and more control. You don't need millions to get started, but you do need a plan. Also some capital and the right guidance. Now on the flip side, commercial real estate isn't for everyone. It's probably not right for you if you're looking for quick flips or instant gratification, or you're not willing to learn the business side of real estate, and you see ownership as a passive hobby instead of an active responsibility. Also probably not for the people who want absolute liquidity or low volatility returns. Commercial real estate is not get rich quick. It's build wealth slowly and sustainably. People who win in commercial real estate are the ones who understand this as a business and treat it like one. They stay curious, they ask questions, they review their leases, and they know their market. They're not trying to time the perfect moment. They're trying to make every moment smarter. If that sounds like you, even a little bit, then yes, commercial real estate might be one of the best decisions you ever make. So that's how commercial real estate works. It's not just about owning buildings. It's about operating a business, protecting your investment, and growing your wealth over time. If you want to go deeper in this subject, feel free to reach out and make sure to subscribe for more breakdowns and strategy videos just like this. Until next time, treat your retail property like a business, not just a mailbox.